This is the Asia Trade. I'm Shery in Tokyo.
And I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for a lower open with tech in focus as Micron's outlook disappoints investors. Amazon, though, hitting $2 trillion in market cap in a rally fueled by the AI frenzy. Also ahead, the yen's tumbled to 1986 lows, raising the chance of another intervention and showcasing the Fed's grip on global markets. Plus, big US banks sail through their annual stress test, paving the way for higher shareholder payouts.
Heidi, we're already well past those levels at that 160.17 when we likely saw Japan intervene back in April. And remember, the FX intervention during April and May was the largest on record, more than $62 billion spent. Right now, we are seeing the yen continuing to be under pressure. But the question right now is, if authorities come into the markets, when will that be? Market watchers potentially thinking it will be after the U.S. PCE data on Friday, because it's all about rate differentials with the Fed, right? Will the Fed cut and when?
And there's some good news when it comes to financial and bank investors, right? We had all 31 of these US banks undergoing the stress test, really sailing through when it comes to these results. All of these firms staying above the minimum capital requirements during a hypothetical recession, according to the Fed. They would take, as a group, nearly $685 billion in losses, driving a larger drop in capital in last year's scenario. But still, the Fed saying it's still within that range of recent stress tests. So this is a third round of what's become an annual exam. Of course, it came out of the 2008 financial crisis. 31 banks, each with at least $100 billion in assets. The Common Equity Tier 1 capital ratio, of course, the highest quality regulatory capital level, would bottom out at 9.9%. That's well above that 4.5% minimum, Shery.
Yeah, ahead of those results, we saw the KBW Bank Index lose a little bit of ground, and you can see right now the sea of red when it comes to futures trading as well. We saw a little bit of gains for the S&P 500, but in late trading, we saw big tech again taking a hit on Micron's disappointing outlook, and that really leading to the broader tech sector, including NVIDIA, to lose ground. We're watching the NASDAQ 100 futures as well, and NVIDIA, which was down about 2%, and after hours trading, we're continuing to see the losses for Micron. But of course, it was really a story of also stronger U.S. dollar towards quarter end, and also given that we were digesting Fed speak, take a look at how Asian futures are setting up at the moment, because that really leading to broader Asian currencies to be under pressure. We talked already about the Japanese yen. Take a look at Nikkei futures currently unchanged, but what we're watching was also the Aussie dollar, because we got stronger than expected CPI numbers in the previous session. A50 futures in China were under pressure as well, but it's all about the Japanese yen at that 160.70 level, Heidi.
And as we said, when you moved to Tokyo, such a sort of prescient time for you to be in Japan as we continue to watch these levels of the yen. Let's get some more market insights with Joyce Chang, who's a chair of global research at JPMorgan. And I mean, Joyce, always great to chat with you. But of course, we come to this point again where the threshold for more intervention seems to get higher and higher. The efficacy of such intervention has proven to be pretty short-lived in the past. Is there really anything that policymakers can do and investors can do if they're concerned, other than wait for the BOJ?
Yeah, so I think that the yen is going to continue to underperform here. It's been the weakest currency amongst the G10, and I think there are rising risks the Bank of Japan will delay the rate hikes until September. We're also looking at now that the Fed will not ease until November as well. So I think you're going to see this remain volatile here. And one thing that we're really looking at also is just the effect that QT is going to have as well, because I think that the Bank of Japan will need to bring the policy rate, much higher over time as they embark on this unwind with quantitative tightening in reducing the JGB holdings. So I do think this volatility and the choppiness is not going to go away, and you could still continue to see the weakness here.
We've seen some jitters when it comes to the Japanese equity rally as it is. Do you think the further concerns over the yen, but also perhaps a delay and a pushback to the BOJ's agenda will impact that?
Well, I do think there is a longer-term structural story that's in place that is more supportive of the equity market here. About higher incomes, exit from deflation. You also have this new reform proposals that's underway for the TOPEX to raise the minimum market cap threshold, and you have a lot of the corporate reforms that are going on. So I would separate that from the weakness in the currency that we see right now, which I think is going to stay with us.
Is it a problem, though, in the long run, if you see this acceleration of depreciation in the Japanese yen and a loss of confidence about the Japanese economy, given that you also warn that when it comes to the Fed, you could see that pushback when it comes to rate cuts, but it could also end up being the high for longer turning into a normal for longer or forever?
No, I do think we are in sort of, high for longer implies that yields are going to come down and that financial conditions will remain easy. And I think the risk here is that the narrative around the Fed will change, not so much this year, where the expectations are for, one or two eases, but really for 2025, 2026 outward, where the market is still pricing in a tremendous amount of easing. And that may not come to fruition. So when we take a look at real yields and where we think we're going to settle on this, we're looking at over 2%. And if you think that inflation is going to continue to run at around 2.5% or so and not get back to the 2% target, we're looking at Treasury yields, 4.5%, 4.75% to stay. So that yield differential just could remain even if the BOJ, does begin its rate hikes later this year.
And those differentials also with other economies such as China, right? What do you make of what's happening in the bond space there, where 10-year yields are really continuing to take that big hit, and we're talking to levels that we haven't seen in about more than 2 decades or so?
Well, I think that the fact that you have yields at the level that they're at in the U.S. right now has really taken capital from so many other parts of the world. When we look at emerging markets overall on the bond and the equity side, we have seen just consistent outflows since 2022. And that combined with that reshoring, even more than the nearshoring, has been getting more capital back to the U.S. I think that this higher for longer means harder for longer for a lot of the emerging markets countries.
And China, of course, is front and center, right? Although in an interesting way, we've seen kind of that decorrelation between China and the rest of the EM complex. How do you feel in terms of where those markets can go, given that we've not really seen a meaningful solution to what is really a longer-term structural issue with the property sector?
Well, I think there's the structural issue with the property sector, which is the Achilles heel domestically. But I also think there's U.S.-China tensions and looking at what will happen with the U.S. elections and what that might bring. And so we've seen the continuation of the tariffs that were under Trump, but could you get even higher tariffs? And could that mean a stronger dollar here and more pressure on CNY? We've also seen very choppy data flow. Industrial production numbers were somewhat disappointing, even though some of the other numbers are showing signs that that stimulus is working. And we've seen some real de-risking by investors and being able to look at China at this stage, given some of the uncertainty that does persist.
It's good that you mentioned geopolitics. Obviously, we're in this sort of election super cycle year and it's only going to get busier. What are the ways that you're sort of expressing some of that risk, particularly when it comes to, as you mentioned, the potential of a second Trump administration?
Well, there's 77 elections this year, and there are still 30 to go. And we've seen more volatility off of the elections because some of the results were more surprising. So the European Parliament elections, you also had, Mexico, where I was just last week, as well as South Africa and India, where you had surprises. So we have been, what we've been seeing is that investors are telling us that, are they going to, take some risk off the table on some of these carry trades that they've had on as we get closer to the U.S. U.S. election. So I think you could see, a summer where, we're just much more sideways here as we wait for those election results. But one thing we would say is that, the commodities, the pullback we've seen in commodities, we do see as more of an opportunity. This is one where, if you were to have a Trump 2.0, I think that, there would be, more focus on, the fossil fuels, but even more broadly, we see about a 10% appreciation that still could play out for the commodity markets, and that there are some structural shifts going on. The demand for gold by emerging market central banks because they want to diversify the reserve assets, the elevated geopolitical risk. So I think commodities is one asset class here that could continue to, offer value in the midst of some of these geopolitical risks.
Joyce Chang, Chair of Global Research at JPMorgan, with her take on, of course, all of the macroeconomic news around the world. As we continue to watch a breaking and developing story in Bolivia, we're now hearing that the Army General Commander Juan José Zuniga has actually been arrested after the coup attempt, as we continue to monitor the political crisis in that South American country. Bolivia's presidential palace was stormed by soldiers led by the general. We are now hearing that Luis Arce, the president, is back in the presidential palace. We also heard from the White House making a statement after the situation in Bolivia developed that the U.S. is closely monitoring the situation and urge calm and restraint in the country. Of course, this coming after that historic economic crisis with the lack of dollars and Arce's government now leaning heavily on China as well as they struggle to really emerge from that economic crisis where they're seeing a shortage of natural gas exports, a shortage of the greenback, not to mention that currency peg that has effectively collapsed. So we'll continue to monitor the developing story around Bolivia, and you can see those pictures coming from La Paz in the capital, and now the president back in the presidential palace after that coup attempt was dissolved and the Army General Commander Zuniga was arrested. Coming up on the Asia trade, we'll preview a big day of annual meetings for Japanese blue chips, including Nintendo and SMFG with the Nippon Active Value Fund, plus market insights with UBS Wealth Management. We also speak to LME CEO Matthew Chamberlain about unique opportunities in Asia's metals trade. This is Bloomberg. Amazon has hit $2 trillion in value for the first time. That puts the company in an elite club of tech giants who have surpassed the key market cap. Our reporter Annabelle Jewelers joins us now with the latest. And Belle, I mean, this is quite a feat, but at the same time, I'm a little bit skeptical given that NVIDIA just lasted a short time in the $3 trillion club.
That's right, but I guess there's a difference. There's the 2 trillion club and then there's the 3 trillion club. At least we can say NVIDIA is very close or very safe above that 2 trillion mark for now. But yes, it's still very rare, even if it only happens for a brief period in time, because you only had Alphabet, for instance, going into it in April of this year. As we said, NVIDIA, Microsoft, Apple, they're all above that 2 trillion mark, but of course they're in that 3 trillion mark instead. So the moves that we've seen in Amazon, it's actually been a little bit whipsawed over the course of this year pretty much, but essentially you had a bit of the highs around April, a bit of a drop off in May, a recovery from June onward, and the factors that have really been driving that, well, it's still around that theme of AI, but where Amazon really stands to benefit in particular is its cloud business, AWS, because what's happening is that a lot of companies are really committing to spending more on their tech projects, and that includes demand for AI services, and so AWS is a really big winner in that. And actually in the first quarter we saw very strong profit growth in that division. The other side and the original side of Amazon, of course, is more the e-commerce division, and here you've as well seen really big plans around cost cutting. bit of a euphemism, of course. Job layoffs is what it really means. We've seen restructuring in terms of their business network. They're saying that's more efficient now. So all of these factors have sort of combined together to see this new high for Amazon at this point in time, and really important given when you take a look at the competitive landscape, especially in e-commerce. Amazon is really facing off those upstarts from China now.
They are working on a plan to counter that, though.
Yeah, so there's upstarts, of course, we're referring to Shein here, and also Temu, which is from PDD or Pinduoduo, a unit of that business. So it's really important to understand what sets Shein and Temu apart from competitors in this space, and it really relates back to their business model in particular, because it's direct to consumer. So what they're doing is they're connecting customers directly to factories, and so they're cutting out the middlemen, they're cutting out intermediaries who traditionally would have perhaps bought a lot of stock from a factory in China, then set up their own storefront on an e-commerce site, and then they would sell to consumers from there. By cutting out that, they're able to offer much lower prices to consumers, and so they've been able to gain a lot of market share in a really short period of time. Now Amazon is really wanting to get in on that action, and so they're also planning to ship goods directly from factories to consumers. So that new mall, they're saying, is going to appear still in Amazon's own website, but for now only open to invited sellers, and could be launched perhaps as soon as July 5. A big question, but of course Amazon very aware of those upstarts, Shein, Temu, and of course back in January of this year we actually saw them lower fees for merchants that were selling clothing priced below $20. So it's just a sign, of course, that they're really sort of hunkering down for a price war, but something that, of course, they're tracking very closely, Heidi.
Bloomberg tech reporter Annabelle Jewellers there. Let's take a look at some of the other corporate stories that we're watching this hour. And a Boeing whistleblower alleges he was retaliated against after raising concerns about a subcontractor's work. The mechanic who worked on the 787 Dreamliner claimed to have observed substandard manufacturing practices. He says he was fired after reporting the issues internally. The FAA has seen Boeing's whistleblower reports surge since January's mid-air blowout aboard an Alaska Airlines 737. An Indian government investigation is said to have found lapses in the corporate governance of Byju's, but has cleared the online education startup of financial fraud. Sources say inspectors also found no evidence of accounting malpractice. India's Ministry of Corporate Affairs denies the firm has been cleared of financial fraud. It says proceedings are ongoing. Online comics company Webtoon Entertainment is pricing shares in its US IPO at the top of the range to raise $315 million. The Naver-backed firm sold 50 million shares after marketing them between $18 to $21, confirming an earlier report by Bloomberg. At that IPO price, Webtoon will have a market value of about $2.7 billion. More ahead on the Asia trade. This is Bloomberg.
It's time now for morning calls ahead of the Asia trading day. Pierre Andurand, the trader who rose to fame because of bold bets in the energy markets, is now stepping away from crude oil. Andurand Capital Management says it fully exited long positions in oil futures prior to the June OPEC Plus meeting, and says it will re-engage in the oil markets when it has more clarity on supply. Meanwhile, the firm remains bullish on copper and cocoa futures, even as prices for both commodities have retreated from all-time highs hit earlier this year, Heidi.
And meanwhile, Ares Management CEO Shery Haidi says he's not seeing any cracks in private credit. Investors on Wall Street have been divided over whether trouble is lurking in the sector as interest rates remain higher. Speaking at the Bloomberg Invest event in New York, Haidi told us that private equity investors are clamoring for cash.
One of the reasons why people are drawn to private credit, aside from the fact that it's had durable performance for a very long time and it's a growing market, is most private credit instruments are floating rate. So almost perversely, the higher rates go and the longer they stay high, the better the return performance, right? So clearly a lot of capital is being just drawn to the IRR opportunity. On the flip side, as rates stay high, it contracts the deal environment. And so there's always this tension or balance between wanting to see the deal machine turn on to drive velocity of capital versus benefiting from high rates. And we're kind of getting to a sweet spot right now. I think now that rates have stabilized and that cuts are on the horizon, we are seeing the pipeline pick up meaningfully, which means you should start to see more deals, more velocity, and even if the base rate comes down, it's still going to offer a pretty attractive rate.
Let's talk more about that. What was interesting is we spoke to the audience a little earlier. We put up a poll, and more than half of the audience believes that deals will meaningfully slow down. And so what are the signs of a pickup? How meaningful could that pickup be?
Well, half the people thought deals were going to slow.
Right.
Interesting. I think in the private markets, what really drives flow is the weight of capital, is the way that I think about it. I mean, most institutional equity that supports the private deal environment has a time limit on it, 3 to 5 years to invest. And obviously, you're always trying to find the right opportunity to invest where you can benefit from earnings or cash flow growth and capture multiple expansion. We're in this time now where people have been on the sidelines for quite some time. Investors are clamoring to get capital back. So that creates some tension for people to start to monetize performing companies. And as the dry powder ages, there's also a catalyst for deal opportunities. So I can only say in our pipelines, we're seeing a meaningful acceleration in deal flow. So I would actually take the other side of the
trade.
50%.
So what do you think about this condition private equity is in? There's been so much talk about this liquidity crunch investors are feeling. How much of that is being satisfied in the credit markets through kind of more esoteric financings we're seeing out there?
Yeah, it's real. I mean, this DPI issue is absolutely real. It has not resolved itself. If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle, what the prospects for your fundraising are based on returns. But everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising. And in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors.
Risk Management's Michael Orgetti speaking at the Bloomberg Invest event in New York. Take a look at how futures trading is shaping up. We had the S&P 500 rising slightly, but in late trading, big tech taking a hit with Micron's disappointing outlook. So we had big chip makers, including NVIDIA, being dragged down. But you have to put this into context, right? Because although we're seeing that pressure on futures trading, we're going into the second half, and already we have a gain of double digits for the S&P 500, about 15% or so since the start of 2024, and also idiosyncratic stories like Amazon reaching that $2 trillion valuation. We are also coming off that Fed stress test, Haidi, and it seems that the biggest U.S. banks have passed easily, so we are expecting perhaps to see a little bit of upside there.
Not upside, though, when it comes to the sell-off that we continue to see, Shery, when it comes to Australian bonds. And this is really now a second day following that Treasury sell-off. The slide being seen on your screen there, that Aussie 10-year yield now up 20 basis points in 2 days. This is the largest 2-day gain since October. That was in September. Inflation came in at 6%. Of course, we've had monthly inflation coming in higher for a third straight month. And really, the expectation being set up by markets is that if we still see that uplift when it comes to second quarter CPI next month, then we are seeing some pretty confident pricing that a rate hike is back on the table. Yields could then move even significantly higher from here. This is Bloomberg.
The yen's continuing drop is showcasing the Federal Reserve's grip on global markets. The currency has fallen to its weakest level since 1986, and that slide is unlikely to stop until the Fed relents on its higher for longer policy path. Let's get more from our FX and rates reporter Michael Wilson. Michael, is that perhaps a reason that we have yet to see indications of authorities again intervening in the currency markets?
I think that they're probably holding off. Like the market narrative now is that there's, that major PCE deflator release in the States on Friday night. And, the common view is that, the BOJ, MLF might get lucky on a softer print. So they might want to just hold fire. The 10 yen rule, the intervention rule, that's like a rule of thumb these days. Dollar yen closed May at like 157.31. So, 167.31 close for June, even on a strong PCE print on Friday, does seem like a bit of a stretch. And on that basis, I actually can't see them coming in at these levels with no good reason. A good reason may well be that if the PCE is strong, but dollar yen hyperextends, as you would say, up to that 165 level, which is probably a little bit too much for comfort. And you might see them come in and just add some liquidity and maybe knock it down below that 160 level by the close or on Monday morning. But for now, I think the market is just holding what it's got. Every month you're picking up about 75 ticks in forward points just by being long dollar yen, and dollar yen's going to have a reasonably good month this month. Mind you, the portfolio managers, when they do their mark to market, they have to raise their price closer to market. So, if the Ministry of Finance was to pull the trigger, you might see some, pretty good action. Last time they did it they started, end of April. They ended up being like a 5% drop. And if that was to happen from current levels, we could be sub 153 without much trouble. If you look at that 5% effect in terms of every time, if we're doing 5% off say 170 yen, it ends up being a lot of big figures. So, it could be in for a bit of a wild ride while this sees itself out. The whole market is probably waiting for a confirmation from the Fed to start that easing cycle, and that's the only real way you're going to get any sort of prolonged stabilization in this currency pair. I think that as long as this drags on, the 10-year differential between JGBs and US bonds, that's about 330 points now. We can't get below that 320, and if that starts to turn higher, well then I think that Ministry of Finance's problems just might double because the market will become more. Right. The convictions will be higher to hold long dollars against the yen.
Speaking of turning higher, Mike, we're seeing kind of an impressive volume of evidence that the inflation fight globally may not be finished just yet, right? Australia just being the latest. How much further do yields have to go here in Australia if we perhaps see another rate hike being back on the table for next month?
Well, we're almost 50-50 for August after that CPI print yesterday. And I do think that the RBA doesn't, hang its hat on what the Fed does, but they're probably waiting for cues from the Fed. They wouldn't want to be seen to be stepping out of kilter. They'd want confirmation, either way. The Reserve Bank Deputy Governor spoke yesterday, and he said that all options are on the table. Like the RBA is as data dependent as the Fed is right here, so it's a bit of an inflection point. I think that the 4.6. They talked about neutral rate of 3.5. If that gets moved up again, then you're talking about a 3-year bond rate, above 5%, and that's really going to hurt some households. Chris Kent made the comment that there's a lot of people selling their houses. The only thing that Australia's got going for it in that respect, that there's a lot of equity that they can cash out. and it's a bit of a transfer of wealth going on down under. But the pressure on the RBA, to ease at all now, I think that they've got to err on the side of caution. I think Bullock has come out and said that. So she's like a hawk in dove's clothing. She would if she could, but she obviously can't. So she's just going to have to wait until this data becomes less sticky, and we have to wait until that occurs.
We'll continue to watch the RBA FX and rates reporter there with all of the latest market moves as we continue to watch Japan, of course, because we have seen that weakness in the Japanese yen continue, and that surge in the 10-year yield as well, past at 1%, as there are more bets that the BOJ will actually move and hike rates in July. Let's stay with Japan because almost 60% of Japanese corporates are holding their AGMs this month, with blue chips including Nintendo and SMFG among the big names meeting today. At the same time, Japan has become the world's second largest market for activist investors, with shareholder proposals at a record high for a third straight year. Let's discuss this with Alicia Ogawa, director of the Nippon Active Fund. Alicia previously directed Columbia Business School's project on Japanese corporate governance and stewardship. It's great to have you with us. I mean, I put out two facts right there. The fact that it's a very, very busy AGM season just this week alone. And at the same time, of course, we have seen more activism across the Japanese markets. But just the simple fact that you have so many AGMs together, doesn't that make it even tougher for these activist shareholders to keep an eye on everything that's happening across corporates as one hurdle of the challenges they still face in this country?
Yeah, it absolutely does make it harder for activists and any investors to participate in the AGMs, which are very important in Japan, a very important source of investor feedback. It does have an interesting historical context, which is in the old days when the Japanese economy was on fire in the 1980s, there were organized crime units who would blackmail Japanese management, threatened to make, sort of a disturbance at the AGM unless they were paid off to go away. And the response by Japanese corporations was to cram all the AGMs, as many as possible, into several days. And that made it impossible for those organized crime elements to participate in this kind of blackmail. And some people would say, well, that's their attitude towards activists, but I don't think that's quite fair. It is the case, as I can see, that a lot of Japanese managers' attitude towards activists have changed quite dramatically. The vast majority of managers would say, I think that this is just a fact of life. You have to live with it. We don't like it. But there are a small group of companies who appreciate that activists are a form of sort of free consulting. So I think this to accuse the companies of keep activists out is not exactly fair.
We have seen, of course, those efforts by foreigners, foreign investors coming in. Elliott taking many stakes, also the likes of Palliser. But is this a foreign-only phenomenon, or are we seeing also activism among Japanese investors?
Not. It's mostly Japanese-led. I mean, some of the biggest and most successful funds are run by Japanese nationals, many of whom live in Singapore for a number of reasons, but some of the most early and influential activists are Japanese. And if we look at, there have been at least a dozen new funds launched targeting Japanese companies over the last year, and the vast majority are run by Japanese nationals. That's important because, in the old days when activists first made an appearance in the early 2000s, it was perceived as a ugly foreigner invasion, but that's not the case anymore.
How much has something like the experience of Elliott really kind of inspired some more activity, both domestically and from international funds, though?
Elliott is actually a very late entrance into this game. The game really started with small and mid-cap companies beginning 5 or 6 years ago, and that space continues to be on fire. And it stands to reason you don't need tens of billions of dollars to accumulate a 3 or 5% position in these kind of companies. They generally do not have the same kind of cross-shareholdings that can present a barrier to engaging or influencing a company. And lastly, largely speaking, the government doesn't really care about these small, medium-sized companies, where there was an obvious need to protect Toshiba or some of the other high-tech, large companies. That's not been the case for small and medium-sized companies. So I think it's thanks to the success in the small and mid-cap space that has encouraged companies like Elliott, like ValueAct, like some of the other bigger activists into the Japanese market.
There's still a lot of work to be done, right? But would you say that the conversations, the receptiveness of management, in these boardrooms and meetings is becoming more open?
I think in general, you're correct. I think, as I said, the vast majority of Japanese managers' attitude is more along the lines of, well, these people are not going away. We have to deal with them. Let's figure out how to deal with them. As opposed to just refusing to meet. But there is a small number of companies who, again, as I said, regard the hard work, the vast amount of research and money spent researching companies and industries that activists usually come in to talk about, a form of free consulting. And those small number of companies are very open to meeting with activists. And finally, you have a sort of renegade band of people in some Japanese companies who want activists on the register because they feel that they don't have a critical mass inside the company to make the kind of changes that they want to make.
And how much are those changes needed at a time when the era of free money is over, right? I mean, we are now seeing the BOJ is starting to hike rates. So how crucial is this to really try to bring some reform to these companies?
Yeah, I mean, the amount of idle resources on Japanese balance sheets, whether it's human capital, whether it's financial capital, whether it's physical assets and land and so on, it's just staggering. And I think that as interest rates rise and costs begin to hit, import costs or rising labor costs, Japanese management understands that they're going to have to run their companies more efficiently. Valuations between Japan and the U.S. have been closing somewhat, but margins are still way behind the United States and Japan, and I think that's the focus.
We have seen, of course, at Tokyo Stock Exchange, also the government tried to take an initiative to push these companies toward these reforms. How successful have they been, and what else would you say that needs to be done?
I think that the CEO of the JPX, which owns the Tokyo Stock Exchange, I always say we need to put statues of him on every street corner in Japan. He has done so much. A lot of the reforms that were announced by the government, the Corporate Governance Code, the Stewardship Code, they are soft law. And a number of particularly foreign investors would say, well, that's not effective because it's not really law. It's just sort of a suggestion. But the CEO of the JPX has made that a condition for being a listed company. And so while it's not law, if you want to trade your stock on the exchange, you have to meet those requirements.
And if you want to bring about change, how difficult is it to really lead that corporate valuation process in a fair and transparent way? Because a lot of these things are set by precedent, right? But the lack of precedent, is that an issue?
When you say precedent, if you're talking about legal precedent, that is an issue. There's still, I think, one of the reasons why the strategies taken by companies like ValueAct are different in Japan than they do in the United States is because minority shareholder rights in Japan is still an evolving discipline. And Japan is not a country of common law like we have in the United States, which relies on precedent. It's a civil law. And so we're still feeling our way in that. And therefore, if you're an activist taking a big position, you have to be quite sure that your interests will be protected. And that's one of the risks, I think, that big activists face, and which is why they are probably not doing the same kind of campaigns that they do in the United States and Europe, which are much more long-term and much more involved. Here in Japan, they tend to be shorter-term visions.
Alicia, so great to have you on with us. Alicia Ogawa, who's a director at Nippon Active Value Fund. You can catch us live and watch those past interviews on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about. You can join in on the conversation as well. Send us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. We're at TV Go. This is Bloomberg. Well, geopolitical tensions have been a key theme at this week's Bloomberg Invest event in New York. Carlyle's Mark Jenkins and Christina Minnis of Goldman Sachs joined us to discuss how global conflicts have forced them to shift their investment approaches.
34 years ago, I didn't pay any attention to it. I mean, I think 34 years ago, you focused on the micro level. I think after the great financial crisis, we said, wow, we should focus on macro and micro. And I think after we came out of the pandemic, you know, the Russian invasion of the Ukraine, we said, geez, geopolitics is actually pretty important. And, you know, just to give you an example, if you look at container shipments today, all right, with the Israel, the conflict in the Middle East, if you will, what's basically happening is the Houthis are basically shutting down that area, which accounts for 15% of global trade. 80% of shipments that went through the Suez Canal are re-diverting. It's adding an extra 15 days to deliveries, and you can figure out what that cost is. So we came out of this very global environment, which we realized how fragile it was through the pandemic, and that it was overly complicated by global conflict, right? Like another great example is, if you remember in the Ukraine, when Russia first invaded, basically there were these clips, plastic clips that were made that were to hold together in the automotive process wires. And guess what? They're probably cheaper to make in the Ukraine than they were in Germany. And so that's where all of them were made. And once they stopped being made, guess what? You need that clip, you can't make a car. And that just showed how fragile the environment was.
And Christina's just continued. Now we have to deal with political volatility in France. That has had quite the impact on bond markets. So how much does it come across your desk day to day?
You know, it's interesting. It's much more acute than it ever was. When the situation in France evolved, you know, in the last week or so, you know, the markets reacted very aggressively. Now the markets have settled down here in the U.S., but talking to my colleagues in London, any company that has exposure right now in France is very concerned, right? And so, you know, I think we would never have paid much attention to the French elections, but now we're paying close attention. And so I think it's just one more element of volatility we have to pay attention to. And to Mark's point, we recently underwrote a situation where 40% of the company's production came basically out of China. And 5 years ago, we would have thought about it. We would have thought about the risks and probably moved forward. That's a pretty significant risk issue to handle, and how you price that and how you're going to package that for investors. So it's 100% front and center in a way that it hasn't been.
Goldman's Christina Minnis and Carlyle's Mark Jenkins with our colleague Danny Berger at the Bloomberg Invest event in New York. And other stories that we're following in global politics, the U.S., Japan, and South Korea have pledged to cooperate more closely on building more resilient supply chains and developing key technologies. In a joint statement, their trade chiefs said that vital areas include semiconductors, critical minerals, and cybersecurity, as well as AI. They said they would work to identify vulnerabilities in global supplies and address weaknesses in strategic sectors. Bolivian President Luis Arce has sworn in Jose Wilson Sanchez as his new army commander-general after troops led by his predecessor stormed the presidential palace Wednesday in an attempted coup. Hours earlier, Bolivian troops led by Juan Jose Zuniga crashed a tank into the presidential palace in an attempt to overturn Arce's socialist government. The U.S. Supreme Court is poised to allow abortions in medical emergencies in Idaho. That's according to a copy of an opinion that was briefly posted on the court's website and then removed. It indicates majority of justices will dismiss appeals by the state without resolving core issues in the case. A court spokesperson says the opinion will be officially released in due course. Julian Assange landed in Australia for the first time in more than a decade after his guilty plea in a U.S. court allowed him to return as a free man. Assange touched down in Canberra after flying from the Northern Mariana Islands, hugging his wife and father after landing. According to the U.S. Justice Department, Assange pleaded guilty to unlawfully obtaining and disclosing classified documents related to national defense. We have more ahead on the Asia trade. This is Bloomberg. Japan's retail sales surprising to the upside, growth of 3% year-on-year. The estimate was for only 2% and an acceleration also from the previous month. When it comes to the month-on-month number, we're seeing it with a growth of 1.7% for the month of May, also an acceleration from the previous month and beating expectations. Of course, we're very closely watching this because inflation has continued to rise across Japan, hampering some of those consumption trends across the country. But we're seeing the department store and supermarket sales have also gained more than 4%. Again, the headline year-on-year number is for sales growth of 3%. And of course, what we'll be watching are those inflation numbers as well from Tokyo that we're expecting on Friday. That will give us more of an indication, Haidi, of where the BOJ could go from here and whether they're ready to hike rates.
That is the big question, isn't it? Well, Shery, the latest episode of Latitude with Jacinta Amin focuses on the world of golf. Live Golf CEO Greg Norman speaks with Jacinta about competing with the established PGA Tour and his strategy to reach newer, younger fans.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. I truly believe we are on the road to doing that already, because when you look at our audience base today, that we have like just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
You can watch that full episode of Latitude, 8 p.m. in Hong Kong on Bloomberg TV.
This is the Asia Trade. We're counting down to Asia's major market opens, and Haidi, we're again on yen watch, but more specifically, we're on watch for the U.S. PCE data. Will inflation have cooled enough in the U.S. to actually let the Fed to cut rates at some point? Because that could determine whether or not we see more intervention coming from Japanese authorities now that we are at those levels and well past the 160 when in April, Japan likely intervened.
And Shery, we have seen this mounting evidence, right? The burden of evidence suggesting that the inflation fight globally is not over. Australia is just the latest kind of example of that. As we see bonds continuing to tumble, yields continuing to surge, the prospect of a rate hike are back on the table for later this year now.
And with that prospect of a rate hike in July by the BOJ as well, we saw those JGB 10-year yields surpass that 1% level for the first time in 2 weeks. We're still above that level. The Nikkei coming online down 0.6% as we continue to watch, of course, Japanese yen well above that 160.17 level when was the first time when we likely saw intervention by Japanese authorities. And of course, that led to April and May and that record amount of intervention of more than 62 billion US dollars. But at the same time, we are really digesting those retail sales numbers because they came in stronger than expected in Japan, growth of 3% year-on-year, and what that means really for sustainable inflationary pressures, which is what the BOJ wants to see. Take a look at how South Korean assets are coming online, because we saw the Kospi gain ground in the previous session, but it was not only about Japanese yen weakness, it was also about Korean won weakness. In fact, all of Asian currencies across the board, we saw that weakness, given that we saw a stronger US dollar as sort of a result, given that we are near quarter end and we usually see some strength because of dollar selling. But take a look at the Kospi right now, down 0.9% at the moment, as the Korean won continues to weaken towards that 1400 level. Haidi.
Take a look, Shery, at what we're watching when it comes to Australia as the bond sell-off continues. And really, this is a market that was sent into a tailspin by the monthly inflation reading, not typically a key reading, but of course gaining prominence as we've seen now 3 straight months of increases in that inflation number. We're watching out for the second quarter CPI, which is much more key in a bigger basket. But if that really starts to show really the same trend, we could see a firming of expectations for more tightening to come from the RBA. We're seeing a little bit of downside at the start of the staggered session for equities at the moment. The Aussie dollar a little bit softer, 66.45, largely unchanged. We did see that jump of about 0.6%, but of course now we're seeing that dominance of the dollar, the greenback strength index, really set to close at the highest levels of the year. The yen, of course, the lowest since 1986, as Shery has been mentioning, and we're also seeing that sort of converse impact when it comes to treasuries as well, really trending in the same direction. We've seen that yield, particularly on the 10-year popping as well, Shery.
Right, and right now we're seeing the Bloomberg Asia Dollar Index falling to the lowest level since November of 2022. And of course, this is a basket of Asian currencies that have high liquidity in the currency markets and large trade flows against the US dollars. We continue to see the strength of the greenback, really a function to do also with the quarter end flows. But at the same time, we continue to hear a little bit more hawkish rhetoric coming from Fed officials speaking this week. But our next guest says that Asian currencies may recover 2% against the dollar in the second half of the year. And that, of course, contingent on Fed rate cuts and also perhaps no tariff shocks, given that we are seeing rising trade tensions. Let's bring in Hartmut Issel, head of APAC Equities and Credit at UBS Wealth Management. Hartmut, great to have you back. So tell us a little bit more about your rationale why we could expect to see a bit more strength in Asian currencies going into the second half.
Yeah. It should, as you rightly suggest, it should come from the U.S. The U.S. has to do the heavy lifting. But if you look at a lot of proxies, for example, consumer, right, you look at the all these excess savings that were accumulated over COVID in particular, right, they're pulling down pretty linearly. So you can predict the people being shut out, and you see also the flip side of it. You see credit card debt that is going up. You see credit card issues going up. So it's a matter of time. Right? The economy is slowing in the U.S., and I believe tomorrow the numbers that we're going to see will fall in line with that. So the question is more about timing than anything else. And we're perhaps a bit more dovish than the markets here with 2 rate cuts for this for the remainder of this year. So yeah, we believe the ingredients are in place that, soft dollar weakness, and then, of course, vice versa, that would be a bit of a lift for Asian currencies.
Does that lift include the Japanese yen? Because we continue to see really incredible weakness, and that to do with the functions of rate differentials, right? So could we expect some of that strength to come back as well?
Yes, I would also here put the ball more probably into the U.S. court. I mean, we do know that even though the BOJ will probably also respond a little bit, also probably in the upcoming meeting in July, but nonetheless, they seem a bit reluctant, surprisingly reluctant perhaps from our point of view. So yes, the heavy lifting will have to come from the U.S. side, but if we look 6 months or maybe especially 12 months out, we do also expect, especially as you mentioned, right, the yield differentials, say on a 2-year, finally coming in below 3%, and that's then no longer attractive for many market participants. We would argue to take the risk of a sudden stronger move from the yen side. So you'll see the positioning change. That is, I think, the playbook over the next couple of months. So yeah, a bit yen strength as well.
And what does that mean for equities? Because we have seen a lot of positivity for Japanese markets, especially given that we also have some of those big tech and semiconductor-related names.
Yeah, we hold a fairly neutral view on the Japanese stock market, and a bit like last year. And I also think I spoke about it here on the program already last year. I said, look, yeah, the returns look impressive if you look in local currency, but I would argue most investors probably would quote the US dollar as their reference currency, and then the performance didn't stand out, and we see a repeat of that basically this year. So what does that mean then? So basically pretty strong, very strong, in fact, local returns, but if you dollarize these returns, then it's actually certainly below the US and even slightly also below Europe. So again, it doesn't stand out. It's positive, but it doesn't stand out. So if we look out from here and with a view of a strengthening yen, and bearing in mind that this is a market that has about half its weight in exporters, you would not expect the situation to change a lot, right? So if the currency strengthens, you would expect these a bit the lid on the export side. In favor of Japan, of course, is the governance improvement and these programs that are also being talked about a lot. But we would also argue, yes, they are positive, but part of that, or part of the success of these programs already sort of priced in, if you look at where ROEs are, where they should be at the current valuations. So it leaves us with a pretty neutral view on Japanese equities.
Give us your view when it comes to commodities, because that conviction on gold, does that suggest that you're expecting more of geopolitical volatility to come? Well, at least around the election results, for example, if you look from a sort of uncertainty point of view, besides the fact that we continue to think that central banks, especially I suppose in emerging markets, continue to buy large quantities and sort of replace also maybe some dollar assets with gold. But yeah, beyond that, on the political side, I mean, if you look at the election outcome with tariffs and all of these things looming, and we have a fairly even chance of between the two candidates of winning. So yes, you probably do want to have a little bit of a hedge, right? You don't want to take necessarily a directional bet on any particular outcome, but if you also position to some extent in gold, that should cover a lot of angles also during these periods that are coming up here. What alternatives are you looking at the moment?
Alternatives?
Alternative investments.
Alternative investments, pretty much across the board. If I fast forward, if we look into maybe mid next year, we will, in our view, find that rates are lower again. So that sort of hunt for yield, right? That is a familiar story from not too long ago, is also gonna come back. So yes, alternative premia, risk premia or illiquidity premia, in fact, will come back in focus, and therefore you will then look also at hedge funds. You will look at private equity, private debt. In fact, you should probably start looking at these already now, so that when we come into a situation where rates or yields in general are lower, and that hunt for yields becomes a more imminent topic, again, you're already positioned to some extent.
Hartmut, before we let you go, how are you looking at what's happening in China, especially with that bond rally and the 10-year yield down to that 2002 low?
Yeah. I mean, we look at it more with interest on the equity side. So China is one of our most preferred markets right now in Asia, and where we take confidence from is, to some extent, the data that might sound a bit unusual, because if we look at property data in particular, especially the primary sales, that's still going down. But if you look closely, where usually the lead is, which is the big city, that we seem to have, the data is still, of course, negative, right? But slowly but surely a bit less negative than before. Slowly but surely we're seeing more encouraging signs on the secondary markets, and then we have more, encompassing packages from the government. So this, of course, then drives also consumption and other things. So we do believe China is actually, we've seen already a bit of a taste what can happen. Valuation still very, very discounted. So yeah, China is something that investors should look at right now.
Hartmut, always great to chat with you. Hartmut Issel, head of APAC Equities and Credit at UBS Wealth Management. More ahead on the Asia trade. This is Bloomberg. Take a look at Asian chip makers in the very early part of the trade. We're just about, 10 or 15 minutes or so into the start of trade here. Samsung decidedly low. We're also seeing quite some steep losses when it comes to Hynix there as well. The slump that we saw in Micron after hours, after the company delivered a forecast that was disappointing to investors, there were some pretty lofty sales expectations there. Let's get more from our tech reporter, Annabelle Drewler. So, Belle, we did have Micron shares hitting a record high just this month. So, is it a sense of sort of too far, too fast, and a little bit of repricing now?
Yeah, well, that was really the big question going into earnings because, as you say, we had really seen that big run-up and a rise of more than 60% this year, and a lot of that coming in just the past couple of months. So investors going into these numbers, they really wanted to see proof not just of earnings growth, but they also wanted to know that the outlook for future demand was solid. Of course, as everyone knows, when you've got those really high hopes, they're very easy to be dashed as well, and that sort of seems to be the case here. Where it's really falling short in terms of Micron is the projections here. So the average estimate for fourth quarter sales was $7.6 billion going into the earnings. That's still a nearly 80% jump on the year. But what Micron delivered was a range of 7.4 to 7.8. So we're still in the range of 7.6. But importantly, there had been some on Wall Street that was saying that sales could top $8 billion for the fourth quarter. So, of course, off the back of that, some people are feeling very disappointed in the market, and that's why you're seeing that big move in after hours, a slump there. Again, one that had sort of been predicted beforehand because options pricing was showing us that we could see perhaps a move as much as 12% in either direction here, down around 8% now. But the big question, of course, is how we trend into the Wall Street Open as well.
Annabelle, were there some bright spots, at least, that investors might have brushed off?
Yeah, absolutely. Some brighter spots out of these numbers. For the fourth quarter, for instance, profit is guiding to be a little bit higher than expected. So $1.08 a share. The expectation had been for $1.02. And then as well, the third quarter numbers were solid as well. You still saw profit jumping around 80% on the year. And the profit per share, again, was a lot higher than had been tipped by Wall Street. Where Micron as well, for the future direction, where it really stands out is in its memory capabilities. And these are, of course, very crucial to AI applications. And that's where Wall Street sees a very key profit driver. So Micron, of course, as we know, it sells a very vital component of AI hardware, HBM or high bandwidth memory. They had very strong sales for their new HBM chip in the just completed quarter. They're predicting stronger sales as well for the fourth quarter into 2025. And so some on Wall Street are just saying, use this drop that you're seeing now as a buying opportunity. There's still a lot of runway for this stock to come, Shery.
Bloomberg's Annabelle Drewler there with the latest on Micron. And here are some other corporate stories that we're watching. A Boeing whistleblower alleges he was retaliated against after raising concerns about a subcontractor's work. The mechanic who worked on the 787 Dreamliner claimed to have observed substandard manufacturing practices. He says he was fired after reporting the issues internally. The FAA has seen Boeing's whistleblower report surge since January's mid-air blowout aboard an Alaska Airlines 737. An Indian government investigation is said to have found lapses in the corporate governance of Byju's, but it cleared the online education startup of financial fraud. Sources say inspectors also found no evidence of accounting malpractice. India's Ministry of Corporate Affairs denies the firm has been cleared of financial fraud and says proceedings are ongoing. Online comics company Webtoon Entertainment is pricing shares in its U.S. IPO at the top of the range to raise $315 million. The Naver-backed firm sold 15 million shares after marketing them between $18 to $21, confirming an earlier report by Bloomberg. At that IPO price, Webtoon will have a market value of about $2.7 billion. We have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade. Take a look at how European futures are coming online, down 0.3%, and reversing some of those gains or loss, actually extending some of those losses that we saw in the previous session. European equities dropped, and it was really a matter of bond yields rising because of those conflicting messages when it comes to the path for interest rate cuts, Heidi.
Yeah, take a look at what we're seeing across commodities. Of course, we've had a couple of guests today, Shery, really bullish on a number of these commodities, particularly when it comes to gold and some of these other metals, given the geopolitical concerns that we have going into an election-fueled rest of the year. We are seeing a little bit of downside there when it comes to crude. The risk are pointing a little bit sort of to the long position when it comes to Brent, with oil bulls starting to pile in, but a little bit softer today. Well, the annual LME Asia Week event begins in Hong Kong today. The conference bringing together top industry leaders, experts to talk about the latest trends and developments shaping markets in metals. Joining us now is Matthew Chamberlain, who's the CEO at the London Metals Exchange. Matthew, great to have you with us. And I guess I'll start off by saying what your priorities are going into this week and what your key focus is when it comes to these Asian markets.
Yeah, perfect. Well, thanks for having me, and it's great as always to be back in Hong Kong for LME Week Asia. You know, I think this is a really well-timed conference because you showed the copper numbers just now, and there's obviously been a lot of action in copper this year. Seen the price go up to $11,000 on a speculative interest driven by the electrification story long term, and then come down a little bit driven by concerns around Chinese demand. And I think it's really great to be here in Hong Kong with really the whole of the Chinese and the broader Asian metals industry in town to kind of hear about the outlook, how people are feeling. I always get great insight, and it's a fantastic event.
And, you know, the LME has been doing pretty well lately when it comes to that recovery in volumes since the nickel crisis, if you will. What's really been driving that?
Yeah, so we've been really pleased by the volumes this year. So volumes on the market kind of up over 30%, and open interest up over 20%. I think there's a few drivers behind that. One, as you say, is the build back from nickel. We've invested a lot of time, and our market has been really generous in working with us to recover from that nickel situation. And so there's a specific nickel story, and nickel volumes up over 80% year on year, as we've seen investors and confidence return to that market. But then more broadly, we've been investing in a whole bunch of modernization, like our closing prices. So we now do closing prices in a much more deterministic way, and we've seen that's brought new users into the market. And then, of course, there's a macro story, a story about the electric economy, about artificial intelligence, demand for copper, etc. So I think you've got a combination of positive factors which are driving that really positive increase, as you say.
And being in Hong Kong, how important is the city for LME as a bridge to China? We've been hearing that perhaps you might be expanding your global metal warehouses network from the city.
Yeah, so the link to China has been crucial for the LME for many years now. And the acquisition of the LME by Hong Kong Exchange back in 2012, I think, was a really clear demonstration of that. So we look at every opportunity we have to bring our business closer to our very important stakeholders in China. You know, again, talking about copper, it's been absolutely crucial over the last couple of months that the Chinese copper industry has been able to deliver copper into our warehouse network in Asia, i.e. that we have warehouses that are easy and available to use for all of our Asian customers. So we take every opportunity to continue to grow that warehouse network, to make it as easy as possible for our Asian users and, of course, our users all around the world to participate physically.
Would that include Hong Kong, and what about the mainland?
Yeah, so we've talked in the past about our desire, if our Chinese partners would be willing to have warehouses in mainland China. Now, we absolutely understand that that's a decision that for China to take, and will be China's partner even when that works. But you're absolutely right. You know, the locations such as Hong Kong providing that bridge into the mainland are very exciting. So yeah, we'll be saying a little bit more about that in our forthcoming seminar. So I don't want to spoil the surprise, but I think it's absolutely right to say that Hong Kong is very much at the centre of our plans for that bridge into the mainland.
I did want to dig a little bit deeper into that, because is that sort of, you know, a bit of a consolation prize, and is it worthwhile from a strategic perspective, given limited warehousing space in Hong Kong, given that it's not a major transit point at this stage?
Yeah, so I certainly believe that, you know, that our mission is to get as close as possible to the mainland as possible. So I wouldn't really use the term sort of consolation prize. I think we already have this incredibly effective warehousing network close to our mainland users. So to take it, you know, the example of Korea or of Johor in Malaysia, or of course Kaohsiung, you know, that we have these very convenient ports already where mainland users can easily ship metal to, as we've seen in the last couple of months, where significant quantities of Chinese copper have been delivered into our warehouses against that high price. So I don't think this is a binary question, warehouses in the mainland or not warehouses in the mainland. It's about creating as effective a network across the broader Asian region so that everyone in Asia, including in mainland China, has that easy access to LME warehousing.
And Matthew, as you're recovering from the nickel crisis, as you say, how confident are you that that's behind you? And have you had any conversations with Xiangguangdao Xingshan?
Yeah, so with nickel, we have invested a huge amount of time and resource, and our market has as well, I must say, in terms of building the market back. And yeah, a number of important learnings, so things like our OTC disclosure. So we now see who is behind over-the-counter positions on our base metals. Things like our daily price limits that we've put a lot of effort into calibration. So you never want to say job done in a situation like this, because we can always continue to improve. But you know, I strongly believe that those learnings that we took from that independent report and have spent the last 2 years embedding have been hugely valuable for our industry. And sorry, it just broke up on the second part of your question.
Matthew Chamberlain, we'll have to leave it there. We're out of time, but it's great to have you in the region, and good luck with the event in Hong Kong. He's the CEO at the London Metals Exchange. This is Bloomberg. This is how markets across Asia are trading at the moment, and really extending those losses that we saw in the Wall Street session. The Kospi down about 1%, with the Nikkei also down by as much. We have most sectors in the red right now, except for utilities and banks. Of course, we have expectations that the BOJ might move and hike rates in July, given the continued weakness of the yen. That drop, showcasing really the Federal Reserve's grip on global markets. The Japanese currency has fallen to its weakest level since 1986, and that slide is unlikely to stop the Fed relenting. The Fed on its higher for longer policy path. Our Asia Economy and Government Senior Editor Brian Fowler joining us now. And Brian, I guess the question is right now, when will the finance ministry come out and say something? And even if they do, will it make a difference?
Yeah, Shery, we're all standing by, on the edges of our seats in Tokyo. We had the top currency official, Kanda, speaking last night quite late, and he had the usual kind of barrage of verbal intervention. He's already at the ministry this morning, and he faced a phalanx of cameras as he entered the ministry. He declined to comment. I think he's kind of pacing himself, not wanting to say everything all at once because it starts to lose effect if he talks too much.
Especially given that we still have the U.S. PCE numbers to look out for.
Exactly. So I think that's the next big potential catalyst. That comes out, of course, Japan time. It'll be Friday night. It would not be strange to see the Japanese authorities jump in after that, depending on what the numbers look like. It would be a little odd to see them go before that because they might just be wasting their money and the opportunity if they do it. But they can't fight the market, really, like that.
That's the whole point, isn't it? Is just more intervention at this point actually wasting money.
Yeah, and Japan, it has a couple $100 billion in reserves it could probably tap if it needs to, but it doesn't want to do that to the point where the market really doesn't believe in it. Right now, the market there's a lot of short yen positions, which on the one hand shows how bearish sentiment is, but it also does open up the possibility that if there is a move in the other direction, a yen rise, you could see a lot of short covering that would exacerbate that move. So a lot of nerves in Tokyo right now.
Will there be nerves at the BOJ as well? Do you think this kind of nudges them towards a policy move in July?
Yeah, Heidi, that's a huge question, and I think maybe the bottom line is yes, it will. BOJ is very subtle about these things, very nuanced. It wants to say that we do not forge monetary policy with currency levels in mind, and that may be true, but with the yen around the weakest in almost 4 decades, it's definitely going to be a factor. It's already pushing up inflation via import prices, and I think that gives the BOJ one more reason to respond to that with a move in July.
So what should we be watching out for right now in the sense that it's not always that spike or fall in the Japanese yen in our price graphs only, is the fact that they do this so-called rate check as well, right?
Yeah, so, they have a lot of tools at their disposal, and one is to suddenly start calling around at banks to see what the price is on offer. And what they're really doing is they're conveying a message. This is a warning. Do not make one-way bets against the yen right now because we are standing by. It's considered a precursor to actual intervention. It doesn't mean that they always follow through with interventions. Sometimes they just do it to sort of send a message. But that's something we're looking for, is any sort of hints of rate checks going on.
Our Asia Economy and Government Senior Editor Brian Fowler there in Tokyo. Well, Beijing has eased home buying requirements for down payments and mortgages, joining the country's other megacities in supporting the real estate sector. China correspondent Min Lo joins us now from Hong Kong. And Min, you can make it easier and cheaper for people to buy, but is the appetite really there?
Yeah, so Beijing is now lowering the down payment ratios to 20% for first-time home buyers and 35% for second-time home buyers if they buy in an urban area. They're also providing incentives to families with 2 children who can now buy homes and enjoy the same down payment ratio for first-time homes even when they buy their second homes. Now, this makes Beijing the last in the first-tier cities to really ease home buying curbs. Of course, we know that Shanghai, Shenzhen, Guangzhou have already slashed down payment ratios and either removed or lowered the mortgage rates to make it cheaper to take up home loans. But this is significant because Beijing really leads a list of major cities when it comes to oversupply. Take a look at that chart there. Beijing topping that list. Its unsold homes will take nearly 49 months to sell. And so these measures, yes, perhaps they could lead to a sales recovery in the next 1-2 months. The question is how big of a boost and how long of a boost, because so far the measures have seen very short-lived effects and home prices continue to slide for 11 straight months now, and many people are just losing the conviction that homes are still a safe place to put your money in.
Exactly. I mean, how many times have we talked about the series of measures coming from authorities? So what's the outlook for the property sector this year then?
Yeah, well, look, the investors, they're still very skeptical about the government measures so far. The central government had unveiled that 300 billion yuan plan to get state-owned companies to buy back unsold homes. It's estimated to create 500 billion yuan in credit overall, but estimates are that China will need 1 to 8 trillion yuan to really mop up those massive amounts of inventory, which is still at a record high. Bloomberg Economics estimates that it will take more than 4 years to really offload those 60 million unsold homes. So the measures are still seen as just a short-term confidence booster at best. There are still very strong calls for the governments to do more to expand that plan, to increase liquidity, to reduce the housing glut, and it may still take some time for consumers to really gain confidence again to put their money back into the housing market.
Bloomberg's China correspondent Moon Low there. More ahead on the Asia trade. This is Bloomberg.
Indonesia's tourism ministry is on a mission to get Chinese tourists to look beyond Bali for their next tropical getaway. Santiago Uno spoke to us at the World Economic Forum in Dalian and explained how the country plans to attract younger travelers looking for different experiences.
Before COVID, China's top 2 or top 3 of tourist arrival into Indonesia. This year, it fell outside the top 3, and we need to work hard to convince Chinese tourists to come visit wonderful Indonesia, and in particular that we're developing Beyond Bali experience for Chinese tourists to experience. And this is something that I aim to be able to achieve with this trip and with the sales missions of 1.3 million tourist arrival from China.
You feel the pressure from the region. Thailand has the visa waivers. There's all kinds of things that are happening there to get, and the Chinese, by most accounts, are going to Thailand. Where are you right now on the visa waiver front?
We're into the final stage. I think it will come just before Pa Jokowi and his term and our term in October, and I believe Pak Prabowo's strategy of continuity will actually also focus on tourism in terms of inviting more tourists to come from all over the world, in particular from China.
What are the biggest challenges, in addition to, of course, getting that visa waiver? I mean, have you seen the spending patterns here? The Chinese economy is slow, they're cautious, the consumer sentiment is pretty low.
We actually have tracked this through our big data analysis, and top of mind of Chinese tourists is still Bali, and they like to have the nature, culture, and adventure experience.
Now, you're the tourism minister, but also the creative economy minister. So I'm sure part of your remit is to get businesses, part of the creative economy, to come to Indonesia as well. Is that part of your discussions here?
Creative economy includes the digital economy, and we just finished the discussions on digital economy framework agreement within ASEAN. Indonesia is a top destination for investments for Chinese investors, but also globally as well. We are transforming our digital economy. We're the largest digital economy in ASEAN. I think $150 billion by next year will be recorded for the largest jump in the digital economy. We're seeing investments from NVIDIA and other AI-related theme coming to Indonesia, and this is also my mandate to not only create investments into the creative economy and digital economy space, but also push more exports into the creative economy products, digital economy products and services from Indonesia that is reaching about $25 billion this year and is going to increase by 10-15% next year.
Are there any negotiations or talks or whispers from Chinese companies that say, hey, if we invest in Indonesia, we manufacture in Indonesia, we can kind of avoid sanctions on products that are re-exported potentially to the United States, or tariffs, I should say?
It would be a win-win-win situations for everybody to work closer together. We have a large EV ecosystem mandate that we're developing, and China-made EV products have made to Indonesia, but we want to increase more investments into the manufacturing side and to the downstreaming of the processing, the industrial processing goods coming out, raw materials in the batteries, also the services and the entire supply chain that we're developing, because Indonesia is the largest market in Southeast Asia, so we need to work together with the best of the best within the industry.
Indonesia's Tourism Minister Sandiaga Uno, they're speaking to Bloomberg Stephen Engel. We do have some breaking news when it comes to potential pay caps for China's financial elite. We're hearing that we're seeing some employees being pressured to return excess pay. According to people familiar, this is a $400,000 pay cap that we're talking about, and these clawbacks when it comes to bonus payments as well. All of this coming, of course, as Beijing tightens its grip on the financial industry and the oversight, all under President Xi Jinping's Common Prosperity campaign. So potentially some of the industry's biggest companies and conglomerates will be imposing these strict new limits. They've asked senior staff to forego deferred bonuses, in some cases even return pre-tax pay in excess of 2.9 million yuan, or about $400,000 from previous years. These are groups including China Merchants Group, China Everbright, CITIC Group Corp are among these state entities that have conveyed that guidance to employees at some of their units in recent weeks, according to people familiar with the matter. Some mutual fund managers also being pressured to return non-compliant pay earned in previous years as well. We've seen this sort of situation being vilified by Beijing policymakers as so-called hedonists over lavish lifestyles. Top-earning finance workers, including the likes of investment bankers, fund managers, have really become some of the most impacted when it comes to the push for more equal distribution of wealth. This is a $66 trillion financial industry that we're talking about, but it's really been coming under more and more scrutiny from Communist Party control. Banks, brokerages have been slashing pay and other perks as well. So we're now hearing that this is this $400,000 pay cap, a potential clawback of bonuses paid in previous years, Shery.
Right, Heidi, as we continue to see also a new round of anti-graft investigations in the country. But these are some of the other stories that we're tracking at the moment. The U.S., Japan and South Korea have pledged to cooperate on building more resilient supply chains and developing key technologies. In a joint statement, their trade chiefs say vital areas include semiconductors, critical minerals, cybersecurity and AI. They're promising to identify vulnerabilities in global supplies and address weaknesses in strategic sectors. Bolivian President Luis Arce has sworn in a new army commander after troops led by the general's predecessor stormed the presidential palace in an attempted coup. Hours earlier, Bolivian troops crashed a tank in the palace in a bid to overturn Arce's socialist government. His administration has struggled with an economic crisis amid dwindling natural gas exports, a shortage of dollars, and a currency peg that has effectively collapsed. The U.S. Supreme Court is poised to allow abortions in medical emergencies in Idaho. That's according to a copy of an opinion that was briefly posted on the court's website and then removed. It indicates majority of justices will dismiss appeals by the state without resolving core issues in the case. It's the Supreme Court's first look at a state abortion ban since the conservative majority overturned Roe v. Wade in 2022. You can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg. And we take a peek at the world of golf with the latest episode of Latitude with Jacinda Amin. Live Golf CEO Greg Norman speaks with Jacinda about competing with the established PGA Tour and his strategy to reach newer, younger fans.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf. There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670 odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. I truly believe we are on the road to doing that already, because when you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
And you can catch that full episode premiering on Thursday at 8 p.m. in Hong Kong on Bloomberg Television, as well as on the terminal and on our website. Let's get back to that Bloomberg scoop that we broke earlier. Sources saying that some of China's largest financial conglomerates have asked senior staff to forgo deferred bonuses, potentially even return excess pay from previous years as companies look to comply with President Xi Jinping's Common Prosperity campaign. For more, we're joined by Greater China Finance Senior Editor Jonas Bergman. So, Jonas, this is just such a fascinating story, and it comes, of course, we've seen increasing regulatory oversight into this sector.
Yeah, indeed. As we say, the era of big paychecks for Chinese bankers and financiers is coming to an end as part of President Xi Jinping's Common Prosperity campaign. It's been going on for a while now, but it looks like it's quite heating up now with, in some cases, some of the largest financial institutions, conglomerates in China are asking senior staff to forgo deferred bonuses and, in some cases, return pre-tax pay, which in excess of 2.9 million won, which is about $400,000. And that's quite a large, change from what they used to earn in the heydays. They were almost paid on par with Wall Street firms. So it's a big sea change for investment or for banking in China, and this also encompasses several Chinese mutual fund managers, where they're also capping salaries. So it's clear that the Common Prosperity campaign is reaching heavily into the Chinese financial industry.
And I'm curious about the broader implications for the financial sector in China, because in public, authorities have, of course, repeated calls for financial markets opening in China. But at the same time, will global bankers really want to work in China if you put these caps?
Well, for now, we have obviously heard that these sort of these directives or guidances, if you will, have been broached to the foreign banks operating in China, but we don't think that it encompasses them quite yet. But obviously, it casts a pall on the whole industry, and they'll certainly have to be as well cognizant of the fact that these sort of new pay caps are coming down heavily on their Chinese peers. So it will be interesting to see how they navigate that, for sure.
Jonas Bergman there, senior editor for Greater China Finance. Right. Take a look at how futures are trading at the moment, because we had some marginal gains for the S&P 500 overnight, and we're seeing the downside pressure on S&P futures in the Asian session. Perhaps not surprising, given that Micron's outlook disappointed, and we saw that drag of as much as 7% in late-hour trading, which really pulled down other semiconductors such as NVIDIA as well. When it comes to the TAIEX futures, also losing more than 1%. As, of course, we have the broader Asian markets under pressure as well. And Haidi, of course, we continue to be in yen watch, which we've been for quite a while already. That 160.17 level broached already. That was the level when Japan likely intervened on April. And then we saw record intervention for April, May, and now we're just on intervention watch again.
It seems like we're always sort of on intervention watch when it comes to the yen, right? But the threshold for that seems to get higher and higher. Take a look at how equity benchmarks are faring at the moment. We're seeing quite a bit of downside pressure, particularly when it comes to Australia. We're seeing, in fact, the biggest two-day slump in over 2 months for Aussie stocks. We see bond yields also continuing to go higher as well on the back of these expectations that with hotter than expected inflation, we could see further tightening on the radar for the RBA. Also seeing the Nikkei off by just about 1%, but banking stocks, financials are bucking that broader trend for the benchmark. They're high for a fifth day on the prospect of higher rates potentially to come. The Kospi also seeing some weakness of about 0.9%, seeing a bit of downside when it comes to Asia chip stocks following the disappointment that we had for Micron overnight there as well. That was a stock that really dropped after the forecast failed to meet expectations. We're seeing that playing out across that space here as well. Shery, we're also, of course, not just the yen, but broadly watching the impact of the higher dollar.
Yeah, because the Korean won really close to that 1,400 level, right? I mean, are we going to see some sort of verbal intervention in South Korea as well? Broadly, Asian currencies under pressure, with the dollar hitting the highest since November overnight. The China show is next. This is Bloomberg.